Good afternoon, everyone, and thanks for being with us today. But before we start, we at LuxFLAG would like to take a moment to thank you all for your support during these last difficult months since the very tragic passing of LuxFLAG's general manager, Sachin Bankalas. Sachin was a great human being and a tireless supporter of sustainable finance. He exemplified LuxFLAG with his passion, ambition, and drive to move to a sustainable future. Thank you. Now, in my role as acting general manager of LuxFLAG, I'm very pleased to see that after only 2 editions, the LuxFLAG Sustainable Investment Week has already gained recognition. And that is thanks to LuxFLAG's associate members who are showcasing this week where they are in the sustainable finance journey. Given the finance industry is on different stages of that journey, this week is about sharing best practices. So we all advance towards the goal of making all finance sustainable at one point in time. For the 3rd edition of the LSIW, as we call it, we thank you for such a positive response with over 3,500 registrations all in all. This is amazing, and I'd like to thank especially our host partners and the media partners. The 25 sessions over the week cover the latest trends and most pressing issues in sustainable finance. We hope you find them useful, but also find some inspiration in the progress being made to harness finance to help find solutions to our current environmental as well as certainly the social challenges. Now, a few housekeeping rules. Slides and the recording of the session will be made available to you sometime after the LSIW. For Q&A, please use the Q&A function at the bottom right of your screen. In case we don't get to have the time for questions at the end of the session, the questions will obviously be forwarded to the host for subsequent responses to you directly. But now, let's turn directly to the session. I'm actually very pleased to welcome you all to our TIC session of today, hosted by Fidelity International. Fidelity International is recognized for its investment solutions all around the globe and is among the top 10 largest management companies here in Luxembourg, the largest fund hub in Europe. For 50 years, Fidelity is helping clients to save for retirement and other long-term investment objectives, also now with a tilt on sustainability and ESG in mind. It brings together expertise to help build a better future for clients and the generations to come. I'm sure it will be very interesting to hear from Fidelity about financing climate change and what is the role of an asset manager like themselves in this context. But I'm pleased to introduce the excellent speakers we have with us today. Let me start with Cornelia first. Cornelia is portfolio manager at Fidelity Funds, more specifically of the Sustainable Climate Solutions Fund. What she is on the equity side, we also have on the fixed income side at Fidelity with Anna Quas, because she is actually investment director in the fixed income team and looks after the ESG fixed income solutions focusing on climate. And last, certainly not least, Sanila Kivric. Sanila is a sales director here at Fidelity International Luxembourg. With that being said, thanks you all for being here with us today and enlightening us. And now with that, Sanila, the floor is yours. Thank you.
As you know, climate change is bringing global temperatures to unforeseen levels. And this warming is very dangerous for life, as we all know. Just to share some figures with you, the rate of global warming over the past 40 years has been 0.3 Celsius degrees per decade. And as a result of the CO2 levels and clearly the human activity. As of March 2020, the Earth temperatures was 1.2 degrees warmer than the 20th century average. And this is alarming. The rate of global warming has accelerated in recent years. And if you look at the recent data, 19 of the 20 warmest years ever have taken place in the last 20 years. So clearly, if we do not change, the global average temperatures are on a trajectory to increase. And if we look at the projections, we are talking about 2.6 degrees as a minimum. So what can we do about it? So at Fidelity, we have adopted a climate change in investment policies. And our approach to climate change is underpinned by 3 objectives. The first one is to manage investment portfolios in line with net zero by 2050. The second one is focusing on the real economy. What can we do about and how can we reduce emissions? And the third one is by achieving net zero on our operational carbon emissions by 2040. Aligned with our broader sustainability investment policy, the policy on climate change covers 5 areas integrated into our investment management. So the first one is focusing on investment decision making. So it's about proprietary climate alignment ratings supporting net zero. Second, it's about active stewardship. It's bespoke engagement, voting across climate change topics. It's also about climate investment solutions. So we are going to talk in the next few minutes about 2 solutions. So it's delivering climate-related solutions to our clients, both on the equity and on the fixed income side. It's about collaboration, of course. And finally, it's about corporate responsibility. So what do we do with our own business? How do we run Fidelity as a corporate? I'll introduce you now to Cornelia first. So Cornelia is a portfolio manager in charge of our water and waste solution, as well as our sustainable climate solution. So she's going to tell you about how we are implementing these principles into our Sustainable Climate Solutions Fund. And right after Cornelia, Anna will be focusing on how we are building fixed income portfolio with genuine impact on CO2 emissions. So Cornelia, the floor is yours.
Thank you, Sanella. So as Sanella mentioned, I am the fund manager of Fidelity Sustainable Climate Solutions Fund. I co-manage this with my colleague Velislava Dimitrova. And I'm going to use the time with you today to address the role that equity investors can play in supporting decarbonisation, and in particular, how we are approaching it with this fund. So just to set the stage, as I know you already know, people often think about climate change as something in the future, something that will affect our children. But the reality is that it's already here. And as Sanella mentioned, we're already at 1.2 degrees warming, and the rate of warming is accelerating, and the consequences are already visible. And we're on track to exceed at least 2.3 degrees warming, more on certain studies by 2050. And so to give you a picture of what this looks like, 2.3 degrees is not a pretty picture. It's beyond anything we would recognise, and it would make COVID pale in comparison. You know, to run through some of these consequences, we would see reduced food supply by 10 to 25%, the impacts of which would be more acute if you consider the growth in population between now and 2050. We could see deteriorating water supply by up to 70% in parts of the Mediterranean and the US. Between 700 million and 1.2 billion people would be exposed to lethal heat waves. And then perhaps the worst of all, with the disappearance of 40% of the permafrost by 2100, then this could accelerate the impacts of climate change, releasing dangerous levels of stored greenhouse gases. But moving on to the next slide, we are seeing a global response. Society as a whole and politicians have started to take note. Now, on this slide, it's a relatively short timeline, but it shows the accelerating momentum globally for decarbonisation, starting with the Paris Agreement in 2016 to a swathe of announcements in 2020 and 2021. Now, 2020 was the year when efforts to tackle climate change intensified, whether that be because of the effect of influential figures like Greta or David Attenborough, or because COVID forced people to pause for thought. What we've seen is unprecedented momentum. And now, regions representing 2/3 of global GDP have zero carbon targets, and shorter-term targets have and are becoming more ambitious. And it's not just governments. Corporates, consumers, and investors, of course, are all recognising the importance of decarbonisation. And on to the next slide. The positive story is that many of the solutions to solve for net zero do exist today. With currently available technologies, were they to be fully adopted, and we're a long way from that, and we'll come back to that, we can reduce global emissions by 80%. Now, the remaining 20% will need to be addressed by new technologies or other solutions like carbon capture or carbon sinks. But current rates of adoption are low, and that's on the next slide. Sorry, what? Yeah, that one, thank you. On this slide, we show you some of the decarbonisation technologies. What you can see is that the y-axis shows the penetration of these technologies. So what you can see is that even the technologies that have been around for a while, the technologies that are commercial and are known to reduce emissions, things like industrial automation or renewables, are used, if we take the example of industrial automation, in less than 30% of plants and factories worldwide. And this is in spite of the fact that there are economic reasons as well as the environmental reasons for it to be adopted. And on the x-axis, you can see what percentage of global emissions are addressed by these solutions. So if we take renewables, which are replacing thermal power, the power sector still represents over 25% of global emissions. So although we're in a position where a huge amount of emissions reduction is possible and can be achieved with solutions that exist today, we have to see adoption increase and increase at an accelerating rate. So if we take one of these themes, building insulation, and we take a market, let's say Europe. If Europe continues renovating buildings at the same rate that it's being done today, it will take more than 300 years to have a zero emissions building sector in Europe. Or renewables, which are the cheapest source of power in most regions globally. But as you can see on this chart, it represents less than 10% of global power output. We need to install at least 5 times more than what has been installed in the last 25 years to get to a net zero power sector. And that's before you take into account any additional power requirements for EVs or the electrification of other transport sectors or green hydrogen. And what the following slide shows you is that we can't just let market forces take their natural course. Otherwise, adoption will be too slow. It will take us too long to decarbonize. This chart shows you technology adoption rates over the last century for a variety of different technologies. And what you can see is that autos took 90 years for full adoption, electric power took 47 years. We have less than 30 years to see full adoption of all these decarbonisation solutions. And so if we go on to the next slide, this is where investors play a role. It's not just about capital or availability of capital, although obviously that is an element of it. It's about channeling capital to the right solutions, reducing the cost of capital, thereby accelerating adoption. And this kickstarts a virtuous cycle. If you accelerate adoption, this will bring down costs. And if you bring down costs, we'll see more deployment, which in turn will lead to reduced costs. This is particularly valuable for technologies that aren't yet commercial. But even for those that are commercial, like renewables that I mentioned earlier, deployment needs to be accelerated, which creates a huge investment opportunity, arguably the biggest investment megatrend of our lives. And using some estimates from Goldman Sachs, it's thought that the total cost of meeting net zero amounts to 144 trillion, or 4.8 trillion per annum. That gives you a scope of the investment opportunity, but also what we need to achieve in order to meet net zero. Now, on the next slide, there are lots of different climate funds on the market, many of whom are trying to tap into the opportunity, but not all of whom are actually supporting decarbonisation. So let's take low carbon funds. These were probably the earliest climate funds. You will find both passive and active managed versions of these. Now, these funds do little to contribute to decarbonisation, as they tend to own naturally or inherently low carbon businesses and sectors, when it is the high carbon sectors that may be enabling decarbonisation. To give you a real life example, investing in media companies or asset managers even, these are businesses with people in buildings that naturally have very low carbon footprints. But we would argue that investing in a utility that's transitioning its fleet and investing considerably in renewables is going to make a much bigger contribution to decarbonisation. Another approach is investing in the beneficiaries of climate change, like healthcare, if we see changing disease patterns as a result of climate change, water companies as a result of water scarcity, clean air solutions as a result of increasing pollution as a result of climate change. These are often called environmental funds. And while these might protect investors from any disintermediation risk, in fact, these are businesses that will probably do quite well in an intensifying climate change scenario. These are passive beneficiaries. They are not actively helping us to decarbonise. So what we're doing in the Climate Solutions Fund is investing exclusively in decarbonisation solution providers, the companies with the technologies or the products to generate a step change reduction in emissions. And we'll talk a little bit more about the sorts of things we're investing in. But if we talk about the impact, we're actually measuring the impact of what we do. We wanted to be able to express both the decarbonisation potential and the current impact of what we're doing. So the decarbonisation potential is what I referenced earlier, where we've taken all the technologies that we've identified as providing the step change reduction in decarbonisation and saying, if all those were to be adopted fully today, which is obviously a huge task, then the decarbonisation potential is more than 80% of global emissions. And then if we think about the current impact of the fund as it sits today, the emissions prevented by the companies we are invested in the fund today, is 596,000 tonnes. Now, that's a bit abstract. So to put that into perspective, for every 1 million invested in the fund, that prevents 4,200 flights from London to New York. And this is done by taking into account the emissions prevented by the products or solutions of our holdings. This is very different from a scope 1 or 2 emissions analysis, which thinks more about the emissions generated to make the end product. We're thinking more about the downstream impact of that end product. The wind turbine, let's say, what scope of emissions is it displacing from gas or coal? Or an EV, what emissions is it displacing relative to an internal combustion vehicle? Or the ability to buy a second-hand item, what emissions is it displacing relative to having to purchase that item first-hand? And to give you an idea of what we are actually investing in today, on the next slide. This is a relatively broad opportunity set because our view is that it isn't sufficient just to decarbonise the well-known sectors like power or transportation. We need to decarbonise every aspect of our lives. So the themes that we're investing in include the more familiar ideas of electric vehicles or renewables or building insulation, to things such as automation tools for farmers to reduce their fertiliser or petrol usage. The cloud, which reduces emissions by 85% compared to traditional enterprise data centers. Reuse platforms, which reduce our reliance on primary materials. Or alternative meat, which can reduce emissions by 90% compared with a beef burger. And on the right-hand side, what we show is the emissions reduction from these technologies. Now, to give you a couple of stock examples, we've got 2 here, and then I'll pass over to Anna. So we talked a little bit about building and renovation, and that the pace of building renovation needs to accelerate. Now, insulation is a key contributor to reducing a building's energy use, and a highly cost-effective way to do so as well. So it both has an environmental impact, but also a financial benefit for the owner of that building, given the payback available. Now, Kingspan is the leader in foam insulation, which has the best thermal performance of all insulation. And they're a very innovative business, developing new products like clear insulation panels to provide daylighting. And they have a substantial runway to sustain or even exceed historical growth rates through underlying growth in renovation rates, ongoing share gains as they expand into newer markets, such as the US, Brazil, and Australia. And then finally, RenewCell, which is a Swedish company. Oh, we don't actually have RenewCell. We have WuXi. Apologies for that. WuXi is the #1 lithium battery equipment maker globally. So they're providing the equipment, but also the full production line solutions for the battery makers, who are then providing the solutions to the batteries themselves to the automakers. And they have a very advantageous position in this market because they have a technology advantage and they work very closely with their customers. So we see a number of positive drivers for this business. Firstly, rising EV demand, which will require increased investment in battery manufacturing capacity. And so we see all their existing customers expanding to new regions, and WuXi is set to benefit from their existing positioning with current customers. And then we have a second trend, which is the automakers wanting to diversify the source of battery supply. And so they're looking to invest in their own battery production. And they will rely on companies like WuXi to develop the full line solution. And then finally, this is a space which is evolving very quickly. And so the technology that was used to make batteries 5 years ago, 7 years ago, is already becoming redundant. And so we're going to see a replacement cycle as the battery makers look to upgrade their existing production lines. And so you have the benefit of expansion of existing customers, expansion into new customers with the auto OEMs, and the replacement cycle at their existing customers. So this is a business that we expect to grow rapidly as a result and to maintain its dominant position. And so this is another position that we have in the fund today. So with that, I will hand back to Sanela or Anna, who are going to talk about financing climate change from a different perspective.
So thank you, Cornelia, and thank you, Sanela, and great job, Cornelia, in terms of lining up a lot of what I'll also be speaking about today. So Sanela, if we can go to the first slide. So I think, as Cornelia touched upon in her presentation, decarbonization is one of the largest investment trends that we see, both for equities and for fixed income. Given the time we have today, I won't spend too much time on this slide, but I think it's important when setting the scene in what role fixed income plays in terms of climate change to highlight the sheer magnitude of investments that are required. On top of the investments required to decarbonize, as you can see here, the 144 trillion, which is something that every time I see that number just absolutely sort of baffles me. You can see that across particular kind of sectors such as energy and transport, building, there are significant investments required to decarbonize. And interconnected to that, which I think sometimes gets kind of set to the side, but is very sort of deeply connected to the topic of climate change, is looking at something like biodiversity and the biodiversity financing gap to reduce biodiversity by 2030 is not an insignificant amount either. So when we're thinking about all of these things, if we, thank you for going to the next slide, many investors will sort of think about ESG or climate change being more of an equity story, largely because of the shareholder rights that exist and the different opportunities that you may have to engage. But actually, credit in the area has shown that it can have quite a significant impact in terms of corporate health and in terms of corporate behavior. And testament to this has been the recent COVID crisis, where we can see the scale of support that has been given to by central banks to credit markets to address this issue. Furthermore, I think if you look at the numbers in terms of the size of the market, the size of the global debt market versus the equities market, it's around 25% more, and it represents the largest source of financing globally. So when we're thinking about how all of these decarbonization projects are going to be financed, the global debt market is one of the kind of key areas which will contribute. So if we go to the next slide. So if we think, looking at the previous stats together, 144 trillion required to decarbonize by 2050, 124 trillion in terms of global debt market. And just to add another number in terms of daily capital that is flowing, around 1 trillion changes hands every day through the global capital markets, and therefore represents the greatest opportunity to drive progress around climate change. So how are we thinking about this in terms of our climate fixed income strategy? So we're thinking about when we look to invest through the debt capital markets, we look to allocate capital to companies across all sectors. I think, as Cornelia mentioned in her previous presentation, it's not about only certain sectors being required to decarbonize, but it's across all sectors that we need to sort of drive change. And so allocating capital to those who are really leading in terms of climate practices and raising the bar for the rest is an incredibly important consideration for us. Beyond that, there are going to be certain areas, for example, the utility sector, which Cornelia mentioned, where it's going to be really critical, and they're part of in terms of making the difference in terms of climate change. So it's really important for us to invest and engage with these companies in helping them progress along their decarbonization journey. And finally, there's been a lot of growth in the sort of labeled bond space, so specifically around green bonds and sustainability-linked bonds. And for us, it is an important component, and we're very supportive of these kind of developments. However, for us, it's important to look at it in terms of the overall context of a company's transition story and ensure that it's not just a one-off project, but rather sort of forms the kind of view of a company's overall sort of decarbonization strategy. So if we go on to the next slide, please. So when we're thinking about building a portfolio, we focus on two areas, really around the climate leaders. So these are the companies that are focusing on best practices in terms of climate change and are really low carbon leaders within their space. So to that point around raising the bar for the rest. And in terms of climate transitioning, so these are the companies, and we invest in across both categories, in either corporate or in labeled bonds, that are setting ambitious targets, whether that be science-based targets or through other organizations, to show that they are committing themselves above and beyond their peers in their sector to really enable transition and to transition their full business to a more climate-friendly sort of approach. On top of that, we focus very much on engagement, as I mentioned, so really pushing on both sides, whether that be climate leaders in terms of having more ambitious targets, or climate transitioning to ensuring that they really are meeting their commitments and meeting their targets. And above and beyond that, also integrating different sustainability considerations. So whether that means in terms of excluding particular companies that may not meet sustainable practices. So really taking a kind of holistic view, both from a sustainability as well as from a climate perspective. So we go on to the next slide, please. So now to put this into practice, what does this mean what does our portfolio look like, and what does our process look like? So we aim to build a portfolio that is really focused on real world economy reduction. Our investments are focused on, we very much focus in terms of both the fundamentals. So when we're looking at the idea generation, focusing on both the fundamental research as well as ESG practices, But throughout, I think each part of the investment process, also integrating climate considerations. So whether it comes in terms of idea generation, so really around the low carbon issuers, or the companies that are focused on transitions or green bonds or labeled bonds in particular cases, on portfolio construction, taking into the both bottom up and top down considerations, but then looking at the overall emissions profile of each issuer within each sector, taking into account particular ESG rating constraints that we may have, or ESG views that we may have that may come through our prop rating. And then also on the risk management side, really sort of, I guess, above and beyond what I would call the sort of classical kind of risk management considerations that you would take, making sure that on a portfolio level, we're also monitoring and managing the risks from a climate change perspective. And then on top of that, looking at how we monitor these issuers in terms of a decarbonization path. So what you can see is, so all these things kind of coming together. So taking the example where we start off with 1,500 utility bonds, and throughout this entire process, which is a sort of rigorous and very sort of detailed process around climate change, to end up with essentially what is a very low number of 13 utility bonds within a portfolio. If we go on to the next slide. So to demonstrate, when we're looking at climate leaders, there are numerous aspects that we take into consideration, which is actually why when you're looking at sort of climate fixed income, it's quite important to sort of have an active manager who can really sort of dig deep in terms of the company's sort of approach. So often low carbon benchmarks, and I think Cornelia, you touched upon this as well, claim to be low carbon, but what they're actually doing is just screening for carbon data. They're looking at one data point and potentially just excluding high emitters. But actually, carbon data alone doesn't really capture the full picture. So when we're looking at how we need to kind of look at our peers, we need to take different elements into consideration. So whether that is looking at it on a sort of narrower peer group basis, so really understanding what are the kind of, how are companies comparable? How are their business models in any way comparable? Because if you take one sector, many different companies within a particular sector can actually have quite different sort of approaches. And you may be comparing apples to oranges in some cases. Understanding what are sort of industry specific kind of metrics. So looking at, for example, emissions per unit of production, normalizing for accounting differences, and like I said, understanding the different business models and different geographies in which they may operate. If we go to the next slide, please. So we're thinking about a transition story. It's important to understand, I think, what we look at is the different commitments that are being made. And this can be through external organizations, such as science-based targets, transition pathway, or for example, through the analysis that has been done through organizations such as Climate Action 100. But above and beyond that, we also work with our credit analysts to really understand what do these kind of commitments look like? How embedded are they into a company's strategy? What considerations, how integrated are they across different companies' business models? You'd be surprised in some cases to sort of look at some companies where you might see that they've set net zero targets, but actually it may not be fully integrated across every single business line that they're operating against. We're looking also in terms of what investments and what mechanisms are in place to facilitate this low carbon transition. And on top of that, really sort of, I think, understanding not only sort of, have they set a target, but what does this target look like and what does it sort of incorporate? Because many different targets can come with many different aspects, and there can be many different shades of what transition a company may be sort of aiming for. If we go into the next slide, please. So I won't spend too much time here. This is just basically to show you how it all comes together. So going from idea generation, then taking into account the sort of portfolio constraints and the different sort of top-down considerations. Go on to the next slide, please. And this is just to show you, to sort of articulate, once we've kind of gone through the sort of research process, once we've kind of understood, you know, whether they are a low carbon leader and what the kind of transition may look like, whether it's a green bond, and looking at the sort of different elements to sort of articulate what a list could look like in terms of going from that 1,500 plus utility sector to basically the 13 bonds that we would consider into a portfolio. And so you can see there's different facets to what we're kind of considering when we sort of build it in the portfolio, really aim towards that either climate leadership or kind of climate transition, as I mentioned. If we go on to the next slide. So this is just to show you essentially that when we're aiming to, when we build our portfolio, what we look towards, if you look at the bottom chart, is you can see actually in terms of portfolio weightings, it's well diversified. So we're not actively sort of seeking to kind of avoid particular sectors that may be high emitters, but rather actually, so if you look at the sector allocation effect, you will see that it's largely, with the exception of sort of energy, largely sort of neutral, but where we're actually driving sort of impact relative to, say, the benchmark is through the issuer selection that we do. So that really kind of helps underpin, I think, you know, the sort of case around when we're looking at, you know, who are the true kind of carbon leaders or climate leaders. This is something which, you know, sort of comes out throughout sort of the emissions profile of the portfolio. If we go on to the next slide. So this speaking to the climate transitioning element, you know, for us, it's really important. And what I should state, you know, we are at this current point in time with our portfolio at 1.5 degrees. It is not a hard target because actually through our approach, we don't shy away from taking on and engaging with some of the sort of high emitters. So this is something that can fluctuate, but what we aim is to be overall sort of Paris aligned. But it's really, we take both that kind of now, how is our portfolio and what is the impact that we're having in terms of current investments, but also ensuring that we kind of maintain a focus in terms of the forward looking against the various different scenarios and the various different timeframes that we have to ensure that we maintain our portfolio sort of in line with Paris and with the various sort of targets. If we go on to the next slide, please. So this is kind of the final aspect that I sort of mentioned, which is around sort of engagement. So for us as a firm, this is something incredibly important, and this is something we sort of overall prefer rather than to sort of exclude across a variety of different sort of sectors, is to really to focus on actually using our ability and strength as an asset manager to engage with these companies. So what you can see here, this is a snapshot of the engagements that have taken place in relation to our portfolio over the last 12 months. I will state that this is, you know, we engage across many different areas and sort of leverage the resources that we have, whether that is through our sort of credit research analysts or through our portfolio managers ourselves, in terms of engaging with companies, but also utilizing the wider resources within the organization, whether that might be on the equity side, through our sustainable investing team, who's leading a lot of work around financing on climate change, or through the collaborative organizations that we're part of, for example, Climate Action 100+. But you can see for us here, you know, this is climate change and biodiversity is very sort of strongly aligned to the theme of our portfolio, and overall as a firm, you know, we're very much engaged in this respect. And this is how we believe as well that we can help companies sort of even further beyond sort of setting their targets, really transition to more sort of lower carbon kind of business models. And then just on the final one. So this is just an example to kind of, I guess, bust the myth around the fact that bondholders can't engage. So Suzano is a paper and pulp company based in Brazil, and we've led a variety of different engagements with them as sort of bondholders. It was initiated through actually the portfolio manager who manages this particular strategy. So for us, it was very much around Suzano had issued a transition bond. We actually used that as an opportunity to sort of engage with them across a variety of different sort of topics. So one, which was specifically around sort of the disclosures that they had actually made as an organization, but above and beyond that, and more recently, which isn't sort of reflected on the slide, which was around their sort of biodiversity approach and sort of transition approach to transition. So Suzano, actually, if you look at them, they are very much sort of on target to actually meet sort of very ambitious climate goals by 2050. When we sat down with them, what we actually noticed was relative to their peers, they had not set particular targets around reforestation or rewilding, which is incredibly sort of important for them and also in relation to both biodiversity and climate change. So we sat down with them and actually engaged with them specifically on actually embedding further biodiversity targets with them within their corporate strategy. In the meantime, they've actually announced additional sort of biodiversity targets to basically look at how are they going to sort of help as an organization, as a company, sort of tackle this specific issue, specifically within the sort of Amazon, and overall sort of contribute as a company towards both better kind of towards climate mitigation and reduction of biodiversity loss. And I think that would be, yeah, that is me. So I think we can go to the final slide, but that is just more, I think we can probably stop there and hand over to Q&A.
Thank you both for your presentations. As you were speaking, we were receiving some interesting questions from the audience. I think the first one is more for you, Cornelia. So you've talked about low adoption rates of some technologies. Does it prevent you from finding investment ideas in some of these sectors?
Yeah, okay, that's a really interesting question. And I would say it's precisely because adoption rates are low that this presents such a sizable investment opportunity. You know, obviously from an environmental point of view, we want to see all those adoption rates at 100% tomorrow, because that means that we'd be well on the way to, you know, fully decarbonising society as a whole. But the sad truth is that we're not there, as you referenced. But the technologies exist, and so we're looking to find the best companies within that technology, and we look at the full value chain. So, you know, if we take renewables, which is obviously a very well understood sector, we're looking both at the renewables developers, but also the businesses that are making the wind turbines and the businesses that are making the towers to sell to the wind turbine manufacturers. And we're trying to find, and so on and so on, and we're trying to find the best investment opportunities to enable the growing penetration of that product, which thereby should support decarbonisation. And so precisely because penetration rates are low today, but also we have relatively high conviction that they need to increase and increase very quickly, otherwise they're going to be catastrophic consequences for our world as we know it. That's why we can invest with such conviction behind this theme, because it's very rare in investing that you can have such visibility, as it were, that you know, that in the case of renewables, it has to go from 9% of power output to about 60%. The rest can be accommodated by hydro, probably more than 60%. And we know that it has to happen rapidly and within a certain time frame. And so that's what as investors gets us very excited about the theme, that we've got this huge growth runway ahead of us, and that that this is going to transition over multiple decades. So this isn't the case of being excited about the growth rates for for a company A for next year and maybe the year after. We're looking on a 20-year horizon, a 30-year horizon.
Thank you. The next one is for you, Anna. It's regarding green bonds. So the question is around green bonds and the low volume of issuance versus the issuance generally in fixed income. So green bonds are very much into the hype, but they represent a tiny proportion of global issuance. Do you expect policymakers to support green bonds?
So I think we'll definitely sort of see, additional sort of policy support around green bonds. I think, it is a very good vehicle, although we put it, I think as I mentioned in my presentation, we put it always it needs to always exist in the context of the sort of overall company strategy. But I think, we've seen different developments around whether that is through the work that the EU is doing sort of specifically around green bonds, or certain organizations such as Climate Bond Initiative, who are really trying to sort of champion the sort of development around this. But I think it will always be sort of complementary. And I think, it needs to sort of be seen in terms of either it is, specifically kind of targeting particular kind of initiatives. So if you look across the sort of breadth of kind of labeled bonds, whether that is social bonds, blue bonds, you can come up with any, there are a multitude of different sort of labeled bonds, specifically kind of targeting projects. But I think, where hopefully we'll see sort of the overall kind of market move is really around general issuance, really targeting and being more specific around having environmental and social kind of KPIs embedded in them. Because I think that is the way, coming back to the sort of 124 trillion, if you still look at the overall sort of size of, say, the global bond market or the green bond market, which is currently, I think, or as per 2020 was around 1 trillion, social bond issuance is kind of going up. But where the great impact can be had is around sort of standard kind of corporate issuance, and ensuring that the companies that are issuing these bonds really are either looking to sort of transition or have really sort of specific kind of KPIs. So I think it's going to be a balance, but I think you will see regulation kind of try to even accelerate even more the development in this space. But again, it sort of needs to sit sort of alongside the overall kind of corporate strategy.
The next one is a question we often get from clients, is about fill ratings. If you could briefly explain the fill ratings.
Yeah, sure. Shall I take that, Anna? And maybe you can add. So Fidelity has developed its own proprietary ratings, and these are done by the fundamental analysts, so the same analysts who are rating it on a fundamental basis. And just as a quick reminder, Fidelity has a very broad team of analysts across the world who have regional and sector specific coverage. So, there's a autos analyst based in Europe, an autos analyst based in she's actually in Shanghai, and across the world we have full coverage, and so there's a huge merit to having, I guess, a dual lens provided by the analysts in terms of both the fundamental and the ESG perspective. I think it's particularly additive when we think about materiality of certain elements of ESG, because these are analysts that know the businesses really well already, so they know what is highly relevant from an ESG standpoint, but also what might be less relevant, and it just provides another lens. We also use MSCI ratings. We're currently rolling out V2 ratings, which are I guess, new and then improved in terms of reflecting, I guess, that materiality that I touched on before, allowing for a bit more granularity in terms of sector relative approaches, so that the analysts will have a bit more control in terms of, you know, what they're comparing, or, you know, which peers they're comparing companies to when they're assessing them on an ESG basis. And so we're really looking forward to the next iteration of ratings. Now, I jumped in before Anna, but I'm sure she's got stuff to add, because she's very well versed.
Absolutely great. I think I would add a couple of points more to that. I think what, you know, and I think this is where, you know, we come together as equity and fixed income, is that the research ratings, you know, each ESG rating that we do is where we have kind of crossover coverage, is very much a collaboration between the equity analysts and the credit analysts. So it is for them to kind of come to a consensus in terms of the overall sort of sustainability of the company. And I think that's really interesting, because you're bringing the kind of two sides of the equation into basically one rating, and sort of building, I think, you know, on top of the point that you made around sort of the sort of material risks. I mean, for us, the ratings also represent, and, you know, for us, I think, you know, specifically for this strategy, but I think more broadly also across the firm, what it helps us is also identify opportunities around engagement. So whether we're looking at, you know, does a company basically need to improve its overall sort of sustainability? So are you lowly rated relative to your sort of industry peers? So do we need to work with you to kind of see how things can be improved? Or alternatively, sort of coming back on the material risks, you know, a company can be kind of leading in terms of, say, social practices, but maybe lagging in terms of environmental practices. So we can pinpoint really the kind of areas which we think are kind of overall sort of important to the company's long-term sustainability, and then seek out sort of engagements and opportunities to enter into a dialogue with them. Or alternatively, also identify, you know, across a particular sector, they may be lagging on a particular topic, climate change, scope, well, on either climate change strategy, or specifically, for example, you know, if you look at sort of the mining sector around sort of scope 3, for example, and then seeking out opportunities where we can actually kind of have a cross-sector sort of thematic engagement program, which we can initiate to drive change across the entire sector. So, yeah, that would be the only thing I would add.
Thank you, Anna. Thank you, Cornelia. Thanks to everybody for listening to us today. So if you have any further question related to the topic we've discussed, please reach out to us directly. Again, Michael, thanks very much for having us again this year. It's been a pleasure. Thank you all.
Thank you.
Thank you.
Especially, it was such a tangible discussion or presentation that you gave. For me, it actually was very transparent also. So super. Thanks a lot for that. And I actually would like to finalize the session with a quote probably from you, Cornelia, which made it really tangible. That was actually the zero emission building sector will take more than 300 years at the current renovation rate. I mean, it's clear adoption must accelerate for decarbonization, but actually putting it such concrete figures to the table, I mean, that at least means that with sustainable finance, we are certainly on the right track. So thank you very much. That was great. Wishing you all the best. And here we continue now with our last session of today at 1700, and it's hosted by us, LuxFLAG, together with the European Court of Auditors, where they basically going to present their special report on sustainable finance. So looking forward to that, and thanks again. All the best. Bye-bye.
Thank you. Bye.